How do we determine the back end split? This is a confusing question for a lot of people, how they figure out exactly what they should take. Now, I'll tell you, doing some expert witness work from time to time, I'm frequently asked this question by attorneys, by courts of law and others, and they want to understand what's a reasonable back end split for a promoter to take. I've seen deals where the promoter gets as little as 5%, and I've seen deals where they get in excess of 75%. And here's sort of how it works. Let me give you a little bit of historical perspective, and then you have to figure out what exactly is going to work for you. So first of all, the less work you do, the less value you add, the less you're entitled to, obviously. So sometimes in situations where promoters are doing deals with large family offices who put in 100% of the money and the manager is contributing really management know-how and so forth, they're called the operating partner. They'll frequently do a deal which is 95-5. So the money partner gets 95% and the promoter gets 5%. In those situations, not only is there a small split, but the promoter just doesn't have a lot of control. When you raise all your capital from one party, it really doesn't bode well. It doesn't give you a lot of control. So that's very significant. On the other hand, deals that go up to, let's say, 50% would be a development deal. A development situation where you buy the land, you entitle the land, you engage the architects, the engineers, put together the drawings, build whatever you're going to build, add tremendous value to the land. Those development deals tend to be 50-50. Everything else is somewhere in between. So if you're doing rehab work, then you might be 60% to the investors, 40% to the promoter. I always think that the money deserves a little bit more, because when you add the fees that the promoters get, it brings it back a little closer to 50-50, which is what a lot of people are shooting for. So, and in deals where, let's say you're managing an apartment building that doesn't have a lot of rehab, you're just mostly collecting rents, anything to the promoter from 10, 20, or even 30% is probably fair. So you just have to really take a look at how much work you're doing, how much value you're adding, and depending on how much and depending on how good a job you're doing in that area is going to determine what it is. Now, how does somebody get 60 or 70 or even more percent and take a higher cut than the money does? Well, that's called a flip or a reversal. And here's what happens is you might start out 25% to the promoter, 75% to the money. And those deals will have sometimes built in a clause in the operating agreement that says, when we get you all your cash back, then it flips. And then instead of you getting 75%, we're the ones that get 75%. And then you get the 25 instead of us. Because now you've gotten all your cash back and you're getting the money out of thin air. So everybody feels great about that at first. But this was happening in 2005, 2006. And what would happen was that the promoters would go do these deals. They would do these very low percent deals. So they would take, let's say, 20, 25% to themselves. They would run around, do whatever fix-ups they needed to do. Then they'd run to the bank and they would get a refinance. And in 05, 06, 07, those refinances were happening, even a little earlier than that. They were happening rapidly and readily. So they would refinance these properties, and then they would return all the capital back to the investors, and then they would milk the properties for now because they were going to be taking 75%, and the investors would get the 25, let's say, out of thin air. Well, that sounds fantastic until the market crash happens in 2007, 8, and 9. And when that happened, many of these properties went into foreclosure. And when it went into foreclosure, the bank did a clawback, is they demanded that money that was returned to the investors that didn't go into the real estate be paid back to the bank. And they were successful in these clawbacks in many cases. The investors, under the limited liability rules, were subject to responsibility up to the amount of their investment. So let's say somebody put in $100,000 and they got returned the whole $100,000 out of the refinance proceeds. The bank might have sued that person for the whole $100,000 back. So the investor had to put the $100,000 back. In the meantime, for the period of time while the investment was working, the promoter had flipped the take home so that he was getting 75, the investor was getting 25. So these deals, they're wild, they're crazy. They're really not investor friendly because they cause the promoter to do things that are really not in the best interest of the investors. And you have to be very careful to take a long view in this business. You have to think about what's in the interest of the investors in the long run. And if you think about the long run, then everybody ends up making more money all the way around. So take care, do good with this business because it's a great business. Now go out and stake your claim.